So, welcome back to another episode of the Scottish Property Podcast. My name is Nick Ponte. I'm joined today with Kessar Salimi and Stephen Clark. How you doing, guys?
Hi, guys. Yeah, I'm doing very well. How are you?
Stephen's multitasking here, so if you hear the kind of background motorway sounds, what are you up to, mate?
It won't be the sound of the engine anyway, that's for sure. I'm actually on a commercial mastermind day with Jerry Alexander, so I'm getting tours around these commercial properties and getting case studies on that. So out and about multitasking, mate, between buildings.
Is that a Nissan Leaf you're driving? No, he's in his fancy Tesla. And we're delighted to have Kessar Salimi, a mortgage broker, on the show today. Kessar's helped us out a number of times on when we were doing the Scottish Property Podcast Lockdown Lives. We had Kessar on quite a few times giving us mortgage updates. So really appreciate you coming back today, Kessar. And today we're going to be talking about 5 things that you can do to increase your chances of getting a mortgage, because obviously, as property investors, we're looking to get buy-to-let mortgages, and sometimes it can be quite tricky, to be honest. They have really kind of ramped up the lending criteria and the things you need to do to get a mortgage. So we're hoping that Kessar's going to give us a little bit of insight into that today, and we're delighted to have you here today, Kessar. So do you want to just give a quick introduction to exactly who you are?
Yeah, thank you very much, Nick. Yeah, thanks for having me on. And by the way, there's nothing wrong with Nissan Leafs. I drive one.
Another Leaf driver. Brilliant.
Yeah, so Nick and Stephen, thanks for all your support over the last year. It's been fantastic being on these podcasts. I really enjoyed them myself as well. Yeah, so my name's Kessar Salimi. I'm a mortgage advisor and also a property investor. Hold a property portfolio between me and my wife. Initially started investing in personal names, and then obviously with the tax changes, now investing in limited company going forward. Got a decent sized portfolio. Generally sort of buy to lets, try to do the buy, refurbish, refinance strategy, and also have a holiday let as well. So a decent sort of variation of properties under the portfolio.
Excellent, good stuff. I think what we'll do is we'll get you back on in a future episode to talk a little bit more about your backstory and your own property investing journey, because I think that's quite interesting as well. But today we're solely going to focus on providing some valuable content to people about, how to go about improving their eligibility basically to get buy-to-let mortgages. So you've got a couple of things that you can suggest to people as a mortgage broker yourself. You must see day to day, people coming to you, and you probably know straight away by looking at their financial, situation and all that, whether they're going to be eligible. So do you want to just run us through and start off? Number one, what would you recommend people do?
Yeah, absolutely. Yeah. Just to start off with as well. So this is just a disclaimer. This isn't financial advice. If you do need advice, make sure you speak to an advisor on your own personal circumstances. And these aren't hard and fast rules. If you're not able to kind of fit any of these sort of criteria, it doesn't mean that you can't get lending. It's just we're looking at kind of options to potentially improve your lending possibilities. And ideally, you want to kind of have the top rung of lending if possible. Because if you if you limit your options, then potentially you're going to pay a higher rate and have less options available to you as well. So if you follow these steps, hopefully you'll have better lending opportunities going forward. So number one is checking your credit score. So your credit file in general is, the lifeblood of getting lending. And there's lots of things that go into that. But really, lenders do look at your credit score and your credit file when they are, looking to do a mortgage application. So a couple of tips that I can give you on improving your credit score, especially on buy-to-lets, if you're doing residential lending, there are lenders who will lend to people that have, not so great credit scores. But in general, on buy-to-let, they expect you to, be able to manage your own finances quite well to then be able to take on another buy-to-let mortgage and start investing, for the future. So, the key things to kind of consider there, things stay on your credit file for up to 6 years, and then at that point they drop off. So if you have had any issues in the past, they will drop off after 6 years. But generally, lenders kind of look at the last 3 years. So if you've missed a payment or something like that after 3 years, it won't affect your credit file as much as it did, if it happened today, as it were. So key considerations is check all the credit agencies. There's more than one. We've got Experian, Equifax, and TransUnion. So I use for all my clients, Check My File. So if you're looking for a credit agency to use, I would recommend using checkmyfile.com, and then that will search all of them, because the information on all three isn't the same. So something might be on Experian, but it might not be on the other two, or vice versa. So
can I just stop you there a wee minute?
Yeah,
that was one of the ones that tripped me up recently, actually. So, like, I was looking on Experian, I think it was, and everything looked great. Looked fantastic. Had a good credit, and I went to get the mortgage application just through the Mortgage Works, actually. Mortgage Works, I've already got about 4 or 5 with them already, so I've got a previous record, and there was no issues. And then it came back that I got declined. And I was like, what the hell? And then my broker said, well, we need to look at all the different agencies through Check My File like yourself. And it came back that there was like an outstanding Eon electricity bill, and that hadn't been paid. And I settled it straight away after I realised, but because it had gone out 6 months, they had marked that on one of the reports, and that caused me the issue, and I got rejected for it. So just little things like that you can easily, if you've got a portfolio of properties, you could miss out on that during like a void period where you're liable for the bills or something. So
absolutely, yeah. And so in regards to that, then, that was going to be one of my points, was that if you do have rental properties and you're registered with utility providers, make sure you keep your details up to date, because that potentially was what happened with one of yours. They might send you a bill to one of your rental properties, you didn't realize about it, and then next thing you know, you've got a late payment, and that could affect your profile going forward. And secondly to that, what I see a lot of clients doing is, if they have a dispute with a utility provider, or typically sort of Virgin and Sky as well, they might be moving house, and, there's a final bill and they don't agree with that. They'll say, well, I'm going to cancel my direct debit. I'm not going to pay you back the £20-30 that, I'm due. And then that then becomes a late payment and eventually a default as well. So my recommendation on that is, obviously, disagree. If you want to disagree with the bill, that's fine, but ideally pay it and then disagree with, and then kind of raise your complaint afterwards, rather than withholding payment as a form of kind of, because that could potentially affect your future affordability, really, for getting lending.
No problem.
So, a couple other tips on that as well. If there is any disputes on your credit profile, then add, write to the agencies as well. You can add a correction to the agencies, so that can help your profile. And if you don't get anywhere, let's say if there's an old bill and you're not happy with that, you can complain to the ombudsman as well, and potentially they might be able to take it off on your behalf.
Cool. I think Stephen's trying to chip in there with a question, mate. Do you want to come in?
Yeah, I was thinking there. So when you apply for a buy-to-let mortgage, the lender does a hard search on your file. That affects your file, because I've noticed that quite a lot recently, because I noticed that my credit score was taking an absolute beating. I never had a single missed payment. There's nothing negative against it, but when I looked into it a few days ago, it actually says that there's been 9 hard searches been recently done on my file. So how do you get around that, or is there a way around that?
Yeah, it just means you're so busy, Stephen. You're buying so many properties. But yeah, no, in regards to that, yeah, absolutely. That can have an effect with some mainstream lenders who look at your credit scores. So, but a lot of the specialist buy-to-let lenders, they don't necessarily are bothered about your score. They're more interested in your credit file in general. So like you said, you've not missed any payments. So that's the main thing. So as long as you're not missing any payments, they'll be happy with that. They're not necessarily going to look at your actual score and see how it's maybe dropped from 900 to 850, So ultimately, when you start buying more properties as well, you'll probably be using more specialist lenders anyway, and they're the ones that check your file as opposed to your score.
Hey, Stephen, get that motor on self-drive mode, by the way.
On autopilot.
And get your mic pumped up, because we can't really hear you that well. Anyway, we'll move on to is that the first point over with, Kessar?
Just a few more things to add to that as well. Yeah. If you have any financial associations with anybody, it might be like an ex-partner or, brother, sister, or somebody that you've kind of either had a mortgage with or a bank account, and maybe you're not linked with them financially anymore, make sure you unlink yourself from that association, because in the future, if they get any bad credit, that could potentially pull your credit down as well. And lastly, credit utilization. So using too much credit as well. We're all in the property game here, and we see kind of, especially some of the property trainers will kind of promote, using your credit cards and stuff like that. But sometimes that can go against you if you're using too much of your credit profile. So, let's say if your salary is sort of 30,000, but you've got 30,000 of debt there. So you've got a debt to income ratio of 1-to-1, and things like that can put lenders off. So, I know not too many fancy cars, stuff like that, not too much debt on your credit cards, especially if your income isn't too high. These things can also have an effect.
Excellent.
This was something
Good
I
stuff.
picked up from you during our lockdown lives. You had mentioned this before. and people were talking about taking mortgage holidays on their buy-to-let mortgages, and I'd put in, I'd apply for a credit card, an interest-free credit card, and I noticed my credit score went up significantly. I actually went up a decent amount of points after it, and when I looked into it, it was because I'd got another 10 grand credit card with no debt on it and no utilization on it. The utilization percentage was so low that it increased my credit score. So I thank you for that.
No problem. No, thank you as well. To be honest, with credit scores, every provider has their own credit score, and some things kind of can improve them. Some things can have a negative effect. But I wouldn't worry too much about your score. Ultimately, it's more just keeping your file clean and make sure that you pay payments on time. So if your credit file sort of jumps from 900 to 999, that's good. But it might not kind of increase your opportunities for getting lending. And same if it drops down slightly as well with a few searches, it might not affect your ability that much.
And I think also, although I got rejected with the mortgage works there because of that red mark on my credit file, I did get lending with Aldermore and other lenders. So, it's not the end of the world. There is other, obviously, lenders you can look at. And that's why, it's important to work with a good broker like Kessar here who can help you out with different options. Do you know what I mean?
Yeah, no, absolutely. Yeah, no, like I said, there is always other options available. So,
does a refusal of credit, does a refusal of a mortgage go against a negative impact on your credit file then?
Sorry, Steve, I didn't catch the beginning of it there.
So does a refusal of lending or a refusal of a mortgage, does that negatively affect your credit rating?
Not necessarily. I mean, some lenders will ask, have you been refused elsewhere? And will want to know the reason why you've been refused. But ultimately, let's say, Nick, in your, what happened to you, all that will happen is that the other lender will have seen that there's been another credit search done. So, yes, ultimately, it's not going to affect you too badly.
Somebody's just jumped in my question here, Kessar. Do these points apply when you're applying for lending in the company name? So that's one of the big things, isn't it? People are now investing through limited company, and some people think that means that they're not assessed as a director of the company, but obviously you're going to tell us different. Yeah.
Absolutely, yeah. So yeah, that is quite a kind of a question that I get quite often is, how does it work and is it different? But ultimately, it's not. So from a lending point of view, I would just look at it as a tax wrapper. They still look at yourselves. So if you're buying a property in limited company, it's based on the directors and shareholders of the company. So they'll still do the credit searches on you. So there's no way around that in regards to buying in a limited company.
Yeah, cool. Do you want to move on to the next point?
Yeah, absolutely. Yeah. So point number 2. Obviously we're going through COVID-19 just now. If you do take some of the help through COVID-19, that could affect your chances of getting a mortgage. There's lots of different things that we've had, over the last year. We've had, the SCISS, which has been for the self-employed clients, universal credit, bounce back loans, C-bills, payment holidays, and furlough as well. So, all these have been great schemes to kind of help people out, through these certain times. But if you have taken these, different types of kind of help, just being upfront with your broker and just letting them know that you have taken that. For buy-to-lets, it doesn't affect your chances too much, because ultimately it's based on the rental of the property as opposed to your own personal income. But it just that way, then the broker can place it with the lender that is okay with you taking these types of grants.
So the one that I just put through recently, one of their very specific questions was, and they obviously asked for the bank statements and all that. They actually saw that I'd taken a bounce back loan on my bank statements, and they came back and they really started asking questions about that. And, they wanted to know exactly what that was for. What was the reason you took that bounce back loan? And they also wanted proof that it wasn't going to be used to fund the deposit as well.
Yeah, I think that's the main one with bounce back loans. Lenders don't want you to use it to fund a deposit. I mean, there is certain bridging lenders that will allow you to do that, but in general, buy-to-let terms, they want it to come from your own funds. Just being open and upfront with your broker and then obviously with the lender as well. I mean, they're not going to refuse you if you've taken a bounce back loan. Many people have taken it out, used it as either a buffer there just in case times get bad, or used it as its intended purpose, to grow your business as well, ultimately. And we're still yet to see how that'll play out, because it's just as of kind of this month, really, as people are starting to make the repayments on bounce back loans and how lenders will assess that for future affordability. But ultimately, these things do need to be factored in, but shouldn't affect your chances too much.
Is it better to be just upfront and transparent? Obviously, like you said, be a broker, just because then it looks better, doesn't it? If you're forthcoming with all the information at the start, rather than them starting coming to you, raising the kind of red flags.
Absolutely. Yeah. I mean, because lenders will find out, they've got access to a lot more systems than we have, and they can kind of see in the background what sort of grants you've taken potentially. So you'd rather kind of be upfront, and then that way the broker can, approach the lender and have the discussion, saying, "No, this is what the client's taken out. Are you comfortable with that?" Rather than, sort of 3-4 weeks down the line, you've already applied for the mortgage, paid all your fees and stuff like that, and then it gets declined because the lender doesn't accept a certain type of grant.
Yeah, I mean there's so many, like you said, there's so many schemes, like you said, furlough as well. People. I wonder if do they look into mortgage holiday payments for your own personal properties as well? What if you've asked for a mortgage holiday?
Yeah, mortgage holiday is a big one, absolutely. So, when you approach a lender and for finance, on your credit file, they can see the payments that you've made on your mortgage, and some of them can see if you've had a payment holiday as well. And actually, a lot of specialist lenders will ask you for mortgage statements for the last 12 months, especially for limited company mortgages, because they don't always show up on your credit file. So they'll ask you for like 12 months mortgage payments to them ones as well. So if you have made payment holidays, it could potentially show that, you've not had sufficient funds there to be able to kind of fund the sort of 3 months of voids or 6 months of voids as well. So that can make them more wary going forward. So they're a great tool to have if you fall into hard times, but I wouldn't take a payment holiday just for the sake of it.
Cool. And I see we've lost Stephen there. His car must have run out of charge or something like that. We've just got a black screen. He should have bought a Nissan Leaf. These Teslas, they're overrated. Oh, you are they? Thought you'd run out of battery, mate. So right, moving on then. Is that wrap up number 2?
Yeah, absolutely. Yeah. So number 3, again, there's no hard fast rules here. If you don't fit this criteria, there still is lending options available to you. But ideally, owning your own home or being an experienced landlord. So when lenders assess a buy-to-let, typically they assess it on the rental income that the property will achieve. So it's quite different to buying a residential mortgage where it's based on your income, and the lenders will give you kind of like a multiple of that as a loan. So what lenders worry is if you don't have your own home or have any other buy-to-lets in the background, are you actually trying to get a buy-to-let mortgage and just move into that property yourself because you couldn't afford to get that mortgage under a residential mortgage? So there are lenders that will do, lending for first-time buyers and first-time landlords, but typically they'll base it on an affordability calculator similar to what you do for residential mortgages. But if you do own your own home, there will be more lending options available to you. Or if you've already got any other buy-to-lets, typically for 6 to 12 months, that again will give you more lending options.
Cool. So, like in the scenario where you are starting out, and say you're quite a young person starting out, can that be potentially quite tricky then if you don't own, your own personal property then?
Yeah, it does definitely limits your options. Like I said, there still is other options available to you, both in personal name and limited company. But typically, they'll base it on your income. Usually, they want you to earn an income of 25,000 and above, and then they'll give you an affordability calculator of how much of a loan you can get, which is quite different to buy-to-lets, where it's based kind of on the rental income, and then you get up to 75% of the value of the property typically. But again, there is options available for you there. I suppose another consideration to factor in there is, the additional dwelling supplement as well. If you buy a rental property first, then when you go to buy your first residential property yourself, you may be liable for the additional dwelling supplement. So that's a second factor to factor in there.
Yeah, that's a good point. I never see. I always think in my head that you always buy your most people buy a residential property first, and then obviously they just know that when they do buy an investment property, there is that 4%. But like you say, that's obviously can work the other way around as well.
Yeah, absolutely. Yeah. And sometimes, you might buy a rental property for 100 grand and then want it to buy your own house for 250 grand. And then you're going to pay the 4% on that. So, it's a lot more expensive doing it that way. So that's something to definitely consider.
Yeah, you find that with a lot of people who are maybe upsizing and keeping their original, say they've lived in their original flat and then they've like met a partner and they've decided to then buy a house, which is, like you say, significantly increasing in value. And they're going up, but they want to hold on to their original property to let out. It's something that a lot of people don't realise. Then they're hit with this 4%.
Yeah, absolutely. Yeah, and the government's clever. That's ultimately what they brought it out for, is to stop you from keeping existing properties. So ideally sell your current property as you kind of move up and down. Whilst before, a lot of investors would keep a hold of that one, convert that into a buy to let, and then buy the new one.
Yeah, good points. Good points. Because you find that a lot of that is sometimes it doesn't really actually make sense then when people want to keep the property because they see it as a potential investment, but sometimes it doesn't always, when you do the numbers on it, it doesn't always just make sense to hold on to it. So yeah, good, really valid points there. Right, okay, moving on.
Yeah. So number 4, so where is your deposit coming from? Ideally, when it comes to lending, most buy-to-let providers want the deposit to come from your own funds. So that could be, from your own savings, from your own business. You could be kind of taking that as drawings, intercompany loan, that sort of thing, dividends. So ideally coming from your own sort of savings is the best way, and that'll give you the most lending options. Moving out the way from there, then it might be like a gift from immediate family. And then as you kind of get further out, that's when it kind of becomes more and more trickier. Because let's say if a third party is giving you a gifted deposit, it's very unlikely that somebody down the street or a friend that is going to give you a 20,000 gift to invest in property. So there's very few lenders that will do that. And then if it is coming from sort of angel investors or the like, then that's where you're really looking at kind of bridging finance, or buying it with their funds purely as cash. So the closer it is to you, the deposit, the more lending options you have available. The further away is, the less lending options that you'll have available to you.
I think, a lot of people don't realise that the lender and the mortgage company, they basically hold all the cards, don't they? Because, if you think about it, they've got 75% stake in it. You've got 25%, or you with your angel investor or whatever. So they, at the end of the day, they're doing a lot of the checks. They want to make sure that everything ticks the boxes. And then, it kind of like, when people come and they start complaining about getting rejected, you can kind of understand why. Do you know what I mean? A lot of time.
Absolutely. I mean, sometimes it can be unfair. Obviously we want to invest in property, but ultimately it is the lender's money, and they need to ensure that they get that money back. So a lot of these criteria sort of that they have in place, sometimes we think it's crazy, but they've maybe been through instances in the past where, it's kind of led them to, having issues with clients and stuff like that. So, I mean, even when we think of kind of gifted deposits, there could be a chance in the future that somebody comes back and says, actually, I want that money back, so, and ultimately the lender wants to have first charge on the property and make sure that, if anything bad happens, that they get their money back. So the less risk for them, the better.
And I don't know, just on that
if you're
point. Sorry, Stephen, on you go.
So, I mean, if you're using angel investors to grow your portfolio, are you saying that you're better to start with bridging loans then, because obviously the bridging finance are a lot less stringent on their checks? But then, if you're exiting onto a buy-to-let mortgage at the back end, will the buy-to-let lender then check where the original deposit came from, or the fact that it's already under the bridging loan, will they care?
Yeah, so I mean, there's definitely bridging lenders that allow you to use angel investors, for the deposit. But yeah, that's a good shout. So being open and honest with the broker as well when you're refinancing onto the buy-to-let mortgage, just to make sure that the new buy-to-let lender is okay with the fact that it was initially purchased with angel investing funds. So some buy-to-let lenders are absolutely fine with that, whilst others aren't. So especially in limited companies, kind of 50-50. Some are okay, some aren't. But yeah, just being open and honest first, so that way then they do check, so they check sometimes at purchase time, or sometimes they get the solicitor to check as well. Because that's the other thing, you could actually have a mortgage offer through, and then the solicitor does the checks and asks, actually 6 months ago, how did you actually buy that property? And they want to kind of see, the deposits, where it's coming from, and then doing all the checks at that point. And that's where sometimes it can fall foul and you get rejected at that point.
If you kind of lie to the broker and they get false information, is that kind of classed as mortgage fraud then? And is that breaching the mortgage terms?
Absolutely, yeah. If you lie on a mortgage application, that is classed as mortgage fraud. So absolutely, yeah, it is against the law.
I was going to ask on the investor front, I mean, it just seems like everybody's looking for investors these days, and obviously it's good, if you can access private money to obviously boost your growing your portfolio and stuff. That is it's a good thing. We can talk a lot about that on the podcast. But as an investor, if you've got somebody coming to you wanting to fund a deal, then and it's going to be, you're getting lending, like you say, through bridging finance or whatever, you're only ever going to get a second charge security on the property, aren't you, as investors, a private investor? So, when it all goes wrong, the lender's going to be the one first in line to take anything out of it. And I think that's quite important when people are putting money into funding deals when individuals approach them.
Yeah, absolutely. Yeah, unless they're using all their funds, the investors' funds, to kind of buy the property outright, and then they can take first charge. But if there is a lender involved, ultimately they're going to want first charge.
Yeah, cool. It's just that it amazes me how quickly people, just jump into bed, like, just throw money at people who are relatively inexperienced, and they're like, I take 100 grand to that project, but then, wait a minute, like, what if it all goes wrong? Like, where's my security here? Do you know what I mean? So it's just a level of due diligence that you should do if you are actually the investor. Cool. Right, moving on.
Okay, so point number 5, have all your paperwork up to date. So one of those things, self-assessments. So if you do have self-employed income or any rental income, make sure you have your self-assessments and you do your self-assessments on time. Proof of address, if you're moving house or have moved house in the past, some specialist lenders in particular will want you to show proof that, even of a house that you moved away from 3 years ago, and have documentation that it was posted out to that address, and also kind of new addresses that, because very few things get posted out to addresses nowadays. So they will typically want you to have, like, a council tax bill, HMRC document, something like that to show proof of address. If you're refinancing properties, lenders will want the tenancy agreements, and make sure you're using the right tenancy agreements. You're not using an old kind of SAT. You're using the new PRTs. If it's a new tenancy, that is. Your EPC's up to date as well. Obviously they only last 10 years. You've got insurance in place, and if you're taking out insurance with a new provider, you're noting their interest on the property. Mortgage statements, we talked about that earlier on. Especially for limited company mortgages, they'll ask for previous 12 months mortgage statements for other limited company mortgages. Just lots of different things like that. If you've got all your documents there, then anything that the lender asks for, you can just fire that across, and it'll also kind of speed up the process.
One of the things that I just get asked for recently, because I haven't done a lot lately in the last couple of years. I've only really applied for a couple of mortgages, so but I was amazed that it was Aldermore that I was using, and I was amazed at how much stuff they asked for. And my mortgage broker was joking with me, saying the only thing they haven't asked for is your inside leg measurement. Do you know what I mean? And it was like constant. It took weeks and weeks of back and forth. But it was weird because they kept coming back every couple of days asking for more stuff. And I'm like thinking to myself, couldn't you just asked for it all at the start? It would have saved us all this back and forth, which must be like pretty much your job, constantly having to chase things. But yeah, things like they asked me for, I mean, I think this is pretty standard, but a full list of the portfolio and all the details when you purchase the property, how much rent, the names of the tenants, all that sort of stuff. Like you say, if you can just keep a record of all that and keep updating a spreadsheet, then it'll make your life a lot, and make the broker's life a lot easier moving forwards. Keep your records up to date, which is a thing that I'm terrible for, to be honest with you.
Nobody likes doing it, do they?
I got asked recently from, I think it was Aldermore as well. They'd asked them how you deal with voids, and actually wanted an explanation of how you deal with maintenance issues or voids in your portfolio as well. I thought that was quite interesting, that they're actually kind of delving into it and treating it more like a business, and asking how you're going to deal with business kind of voids in these properties. Is that quite common, Kessar?
Yeah, absolutely. So once you've got more than 4 4 or more mortgaged buy-to-let properties, you're classed as a portfolio landlord. And then, Nick, like you said, they're going to ask you for these Excel spreadsheets with all your properties on it. And Stephen, like you said as well, they will ask you for a business plan. So, how many properties you've got, how many you're expecting to buy in the next 12 months, any void periods, how you're managing that, do you have a letting agent? So they just want to kind of do a background check to make sure you are managing, like you said, as a business, as opposed to just kind of winging it ultimately. So yeah, definitely keeping your paperwork up to date. And so another thing to add to that as well, doing the buy, refurbish, refinance. If you're adding properties, keep hold of your schedule of works and the cost of works as well, because especially if you're refinancing quite quickly, within the 6 months even, lenders will want to know how you're adding the uplift in value. So if you have all the paperwork for that, you can just fire that across, and then that ticks that box off for you.
Just on, you mentioned the 6 months there. Obviously, that's one of the most talked about things on social media, the 6-month, rule. It's not really a rule, but it's a kind of, what's the latest on that, and how are people getting on with that? If you can just touch on that, like, briefly.
Yeah, exactly. So most lenders adhere to, only allowing you to refinance after 6 months. Typically, if you're refinancing within the 6 months, they'll only allow you to refinance at the purchase price, which obviously most property investors aren't looking for. We're looking for open market value. So the good thing is, especially for Scottish investors, there is a couple of lenders out there that will allow you to refinance within the 6 months at the open market value, but they just want you to kind of document how you've added the value to that property. But if they're comfortable with that, and it's got to be kind of a decent size refurb, it can't just be, you bought the property for 80 grand and you actually think it's worth 100 and you just refinance it straight away. They'll want to see you've actually added value to this property. But if they're comfortable with the sort of the schedule works that you've provided and the surveyor that goes out is comfortable with the uplift in value, they will lend within the 6 months.
Cool. And since we've got you, Kessar, I know we've covered 5 really good points there, which has been really valuable, really helped people a lot. But since we've got you, let's talk about current COVID times. Like the big kind of topic on everybody's lips at the moment is, the risk of high inflation rates. It's what everyone's talking about, and obviously how will that kind of translate through to, the property market. And there's talk of, increasing interest rates potentially, as that's the kind of tool that they can use to kind of control inflation when it can get out of control. So, in your view, what should people be doing right now to kind of look at the possible, macro economy and think, how can they limit their risk potentially when interest rates could start rising? Do you know what I mean? I know, again, we can't offer financial advice, but is there anything that you would sort of, anything that springs to mind that you could be doing right now?
Yeah, that's a great comment that, and absolutely that's on, the back of everybody's mind just now. Ultimately, how's things going to play out in the next few years? And like I said, we don't know how it's going to play out ultimately. But the good thing is, especially after sort of the last financial crash in 2008, there's a lot more regulation involved now with buy-to-let mortgages to hopefully kind of stop sort of similar things happen like what happened last time. So the rental stress test on properties is a key thing for a lot of people. So if you feel like, the property that you're buying isn't fitting the rental stress test, you really kind of think about, is that the right property to buy? So basically what the lenders are doing in the background is making sure that the rental will cover the interest payments, not just for today, but in the future times of interest rates of 5 to 5.5%. So they kind of factor that in on your behalf, and also adding in additional there for taxation and voids and stuff like that. So definitely that's one thing to consider. And ultimately, if you're worried about interest rates going up in the future as well, there are longer term products available now, where you can kind of fix for 5 years, 10 years, and even the whole term of the mortgage as well. So if you're happy to kind of pay that rate now and you're kind of comfortable kind of fixing in for that long, then that's something else that you can potentially do.
Yeah, absolutely. I think that, like you say, times have changed, right? So, some people keep talking about, what about the interest rates of like 1990 when it was like 14% and all that? That just can't happen again, right? It just can't happen. If they're going to rise interest rates, sure, it's just going to be tweaking it slightly, 0.25% here, up a little touch. Like you say, if you're stress testing at like 5.5%, then hopefully that's going to cover you. And then in terms of the property prices, they would need to drop. Most people are 75% loan to value. So to get into like really serious difficulty, they would have to drop like 25%, which I just can't see happening. I don't know if you've got a view on that.
Yeah, absolutely. I mean, obviously, we was both investing in, Stephen as well, pre-2008, you could get sort of 125% mortgages at that time. So things are very different now, absolutely. So that's kind of a buffer in itself. And you're right. I think people would struggle, and people do struggle, when we're sometimes quoting people where the interest rate's gone up by 0.1, 0.2%, and they're complaining about that. I think, potentially we'd have sort of a global meltdown if people were paying 1, 2, 3% higher than they're paying just now. I think people have just got used to such low interest rates for so long.
Yeah, no, that's a good comment. Stephen, do you want to add anything in? He's away. He's had enough of this chat. This stuff's too boring for Stephen. He's off to do deals, man. So we've got a quick question from Colette. Actually, we'll just wrap up shortly. But Colette Dunsmore has asked on Facebook, if you can install new Windows, etc., should you then get someone out to update the EPC? Hang on, I'll just show you the question. Should you get somebody up to update the EPC before you apply for a new mortgage, or is that done by the valuation surveyor when they come out? Do you know the answer to that one, mate?
Yeah, it's a good question. So, I mean, ultimately, when it comes to the lenders, they'll just want to see that the EPC is up to date and it fits the minimum EPC regulations. So, for now, they base it on the English rules. Although the Scottish rules have kind of been delayed slightly. So, the property needs to meet a minimum level of E or above. So ultimately, if you've added windows to the property and the EPC has not been updated, as long as it meets the level E, then that's fine. But I suppose if you have, added some improvements, it would be worthwhile getting a new EPC done at the same time, and that could bump the level up. And then once that's kind of onto the new onto the EPC register, the lender will be able to see it there. But as long as it meets the level E or above, that's fine from a lender's point of view.
Yeah, minimum EPC requirements definitely going to be a big thing in the future. Sorry, I did see an article saying that there was some lenders offering, I think, favourable rates for people with really good EPC ratings. So that's quite interesting.
Yeah, that's right. Yeah, you have EPC ratings of A and B. They're offering discounted rates, and some of the lenders are actually offering further advanced products now to make improvements to their properties. Because, like you said, that's going to be a big thing going forward.
Cool. Well, I think that pretty much wraps it up for today's show. So I'd like to thank you very much, Kessar, for taking the time to come on, and it's always great having you on. So thank you.
No, thank you, Nick and Stephen, as well. It's been a pleasure being on. Thank you very much.
And where can people reach out to you if they're looking for
having you on as always,
advice?
mate.
Thank you, Stephen, as well. So you can find me on my full name, KessarSalimi.com, or I'm quite active on social media as well. So either Instagram, LinkedIn, or Facebook, either of those. If you want to connect with me there, there'll be plenty of sort of contact details where you can get in touch with me through those channels.
That's great. Thanks very much, Kessar. And as always, guys, if you could take a wee screenshot of the podcast and share it out. I'm sure we're all on Instagram here, so I'm sure Kessar will be happy to basically put that on his Instagram stories as well. It'll gain you a few more followers. And if you've got time, please rate and leave a review on the podcast as well. Stephen, do you want to give the final word? No, he's just got other things going on today, man. You need to get your priorities right here. 10 a.m. on a Tuesday. Show up for the podcast and get your priorities right.
It's my technology not working. I'm struggling to unmute myself.
Right, never mind getting a new car. You need to get yourself a new phone.
Thanks very much for joining us, guys. I really appreciate it. I know that I always take value from our chats, and I know the listeners will as well, mate.
No, thank you very much, Stephen. Thanks, Nick, as well.
Cool. Take care. Bye for now.
Okay, bye-bye.